As I've said many times, we need to fix the housing market now to get the broader economy moving again and creating jobs. Fixing the housing market must involve using multiple strategies to attack the problem from different angles, and refinancing should be one of those strategies, particularly for borrowers who are making their payments but whose interest rates on their mortgages are above today's interest rates of 4 to 5%. That's why within the next few days I'll be introducing with Senator Boxer an important and widely supported bill called the Responsible Homeowner Refinancing Act of 2012. It is supported by borrower groups such as the Americans for Financial Reform, the National Consumer Law Center, the National Council of La Raza, and CRC, by the National Association of Realtors, the National Association of Home Builders, many lenders like Quicken Loans, and some mortgage investors like Amherst Securities. Our bill would help 17.5 million borrowers who have Fannie Mae and Freddie Mac loans, but who are trapped paying interest rates above 5% because of barriers to refinancing. Our bill would make it easier for homeowners to refinance and lower their mortgage payments, which is a popular and common sense way to help the housing market. Allowing a homeowner to refinance from a loan that's 6% interest to a loan that's 4% interest, for example, would save them hundreds of dollars a month, putting more money in their pockets, reducing defaults and foreclosures.
Senator Menendez.
Thank you, Mr. Chairman. Thank you, Mr. Secretary, for your service. You mentioned in your testimony that lenders in the HARP report that, in the HARP program, report that borrowers are saving as much as $2,500 per year, which, as you point out, is the equivalent of a big tax cut for those borrowers. But am I correct in saying even that figure doesn't include the additional savings borrowers could get if we enacted the Menendez-Boxer draft bill and increased competition in the HARP refinance market by making it easier for lenders who aren't currently servicing that loan to compete for the business?
There's no question that you would both increase the savings to families that are already planning to refinance, and you would make additional homeowners eligible or make it economic for them, if you will, to refinance. So it has both those benefits, increasing the amount of savings for folks who are already refinancing, as well as expanding the pool of families that we would expect to refinance.
And do you have any sense of how many additional individuals, how many additional could borrowers save, I should say?
Just looking at the appraisals, we're talking about hundreds of dollars for those borrowers just on the refinancing cost. When you add to that some of the fees for example, above water borrowers who may already be refinancing, you're looking at adding hundreds, and in some cases even as much as $1,000 a year in potential savings. What I'll tell you is, with the reductions that we've announced that go into effect on June 11th for FHA borrowers, the fees alone we expect to be about $1,000 a year in lower costs. So that's absolutely critical.
Really significant. So if I've been patching the roof that's leaking in my home, I now will have the wherewithal to replace it, which is, of course, of value to preserve the property value, but also is a tremendous economic ripple effect in our country as well. Am I correct, Mr. Secretary, that FHFA making further changes in HARP 2 as outlined in the Menendez-Boxer discussion draft would actually save the GSEs money because of reduced defaults once homeowners' mortgage payments are lowered?
All of our modeling suggests that there would be significant savings to the GSEs in terms of lower default rates. I think Chris Mayer here, professor at Columbia, testified about specific numbers that he expected that exceeded $20 billion. Our expectations of take-up are somewhat lower than his, but still you're talking about substantial sums that could be saved from lower defaults.
Yeah, as a matter of fact, Professor Mayer at our subcommittee hearing that I chaired a few weeks ago estimated that the resultant GSE profits of as much as $23.7 billion. So whether it's your lower range or that range, the reality is you're talking about significant saving taxpayers' money and reducing the size of any fiscal challenge in the future. The other question I have is, do you believe that the HARP 2 policies, some implemented by the GSEs and some by the servicers themselves, are reducing competition among banks and ultimately decreasing the effectiveness of HARP 2 and robbing homeowners of savings through lower interest rates? I think we try to address that based upon all the things we heard in the hearing, and I'm wondering how you view those.
There's no question that while many of those barriers to greater competition were removed by HARP 2.0, that your bill targets the critical remaining barriers. I'll just give you one example of what's happening at this point. Because servicers who currently service the loan and already have all of the data through the GSE systems to be able to refinance, they only have to do, for example, a verbal confirmation of employment in order to proceed to refinance. Other servicers who would want to compete to refinance that loan still have to go through a fuller underwriting in those systems, including, for example, getting a full W-2 and all of the documentation around not only employment but income. Those are things that, given, again, that the risk already exists on the GSE books, we think just don't make sense here. And because they've already been removed for the existing servicer, we ought to go the next step and make sure that there's competition. I think Lori Goodman estimated that the potential was to save as much as $15,000 per borrower by increasing the competition there on the refinancing of these loans.
And one final comment on your remark. In the panel that we had, I think we had about 6 witnesses representing a wide range of views. There was unanimity on the view that asking for all of that documentation when in fact already, the risk is there, was not necessary and actually added as an obstacle towards refinancing. So it was interesting for me to hear you, and some of the most conservative members of the panel had that view as well. Appreciate your responses. Thank you, Mr. Chairman.